Good afternoon and welcome to another amazing edition of Beyond the Numbers here on the Joy News channel. My name is Winston Taki and I'm doing this with
Isaac Akufo-Addo and Winston. Enjoy the show.
Indeed, the Treasury bills are falling. They are not falling in love, they are not falling in the gutters, but the rate is going down
Absolutely.
marginally. And that has been amazing for quite some time now. If you assess the impact for several years, this year 2025, from the new government, from the optimism and expectation by investors, this is the highest fall in rates.
Well, so if you are wondering how Treasury bills have actually saved the former administration and how this new administration is talking about Treasury bills. Treasury bills simply is a short-term way that government actually borrows money, right? And what we are learning is that this was a market that had very lucrative rate. The rate was as high as even 30% last year, and people were absolutely
been there for quite some time.
And people were cashing in, right? But what we understand, according to the current finance minister, who has given an indication of where the country is at the moment with Treasury bills, and he announced in the 2025 budget with smiles on his face that, look, the Treasury bills that we inherited, the rate was as high as more than 28%. We are glad to inform you that we have reduced the rate to somewhere 17%. And we'll be looking at that figure on the smart wall right now, looking at how the Treasury bill has actually fared since this government came to power. Let's look at that. From 28, we are talking about the 91-day Treasury bill. From 28.19%, now we are talking about, somewhere 17.72%. And the finance minister actually announced this with smiles on his face, and he says they have actually done that, and that is good news. But we've been analyzing and saying that, look, you can reduce Treasury bills, but what are some of the implications of a Treasury bill that went as high as 30% to now around 17%? What is the implication? How does it affect the stability of the city, Winston?
Interestingly enough, for the past year, we've experienced the domestic debt exchange program. Government had to restructure and ensure its fiscal outlook is positive. And that came with a lot of burden. The former finance minister, Akufo-Addo, said we have to ensure there is burden sharing. However, the burden was enormous on the middle class. We saw people losing huge sums of money. They've invested for several decades. Pensioners also had to hit the streets. All those conundrums happened some years back, not too far time. But it appeared that the ripple effect in the money market, in the financial market, was enormous. The banks and the industries, the financial sector, seems to be improving since the last quarter of 2024. If you look at the books of some of the banks reporting profits, and some are also saying that their books are looking good, and that is reflective in the first quarter. The difference has to do with what the new government was going to bring to the money market. What kind of optimism in terms of the economic outlook in 2025 would the government come in to do? The finance minister, in his presentation of the budget, gave key indicators. First of all, he was prioritizing revenue improvement. And initially, the previous government had challenges in raising capital in the international market because we're cut out. Now, we have to rely on the rates that were offered to them, irrespective of how
lucrative rates,
how costly it was. And that was the only option. So government has to buy the bullet and take it like that. But in 2025, we've seen the rate drop by over 300 basis points, and that has been astronomical to 17.72%. The dynamics of it has to do with, initially, we understood that it is only when the policy rate is being fixed, that's when we see some reduction in the interest rate and also the Treasury bill rate. But for quite some time, the rate has gone much, even though the central bank has maintained the policy rate at 27%.
Many have said that this year's budget actually gives a lot of hope to the private sector. Because if you had a T-bill rate with a market which is saturated with government activities and government, offering lucrative rates around 28%, 29%, it priced out the private sector. But now government is deciding to go back to the normal level. But going back to the normal level wouldn't come with just some, it would definitely come with some sort of disadvantages. And that's why we are privileged to be joined by Dr. Richmond Etuahine, who is a banking consultant. He will be helping us break this down. And in fact, Treasury bills are currently down. The private sector will be happy, but there is some sort of headache, not just for the private sector. The private sector is not just happy, but there is a side of the story that we need to tell in terms of if you are reducing the T-bill rates from 28 to 17, then that means that, and we understand that even the rate that were actually offered, people were still buying. People wanted to lend to the government, and government had to reject some of the bids. The question is, the difference between the bids that were accepted and the bids that were rejected, where are these investors, investing this extra cash? Where are they going? And we did the analysis, and the hypothesis that we'll be testing this afternoon is falling T-bill rate. What is the impact on the stability of the Cedi? And Dr. Richmond Etuahine actually joins us. Doc, good news maybe for the private sector, but I mean, what should we be worried about, the falling T-bill rates and the stability of the Cedi, Doc?
Thank you very much, and good afternoon to your cherished viewers. I think this is a very good program because we are in a dichotomy. In one way, you're trying to save by bringing the interest rate, the treasury bill rate down. In one way, you're going to face the consequences of currency depreciation. Why I'm saying so is that at this time of the year, up to April ending, banks are declaring profits. The telcos have just done that. They're all going to put pressure on you. So if you don't take care, you're going to put a lot of pressure on the monetary side of the equation. And I would have thought, prudently, two of them should have worked together and see how we can drop it.
You mean the finance minister and the BOD, the central bank, yeah.
Definitely. One is looking at the fiscal, one is looking at the monetary. Whatever you do at the fiscal may have repercussions on the monetary. And this is what we're going to experience. If you check from last week, the Cedi on the market has declined from, I think it's now 15.85 to 16.15. And if you don't take care, it's going to get worse. Especially when the dividends are being declared, like the telcos, the banks, all the foreign banks are going to declare profit, and they will declare dividend. And it will put excessive pressure on the Cedi rate. So we need to track very well, cautiously. I don't think we are tracking cautiously.
Prof, you made mention of the fact that we are not tracking cautiously. How about the fact that this sentiment that has been expressed in terms of how investors are approaching the T-bills kind of give a positive optimism in terms of investor confidence in the economy, considering how far wide we were when it was difficult for government to meet its treasury bill target?
Well, that is why you're torn between the two evils. You want to look at the physical side and you want to look at the monetary side. And confidence is not only coming because people are buying treasury bill. The Cedi has been very stable over the last 1 month or two. But if people begin to see that the treasury bill is not very lucrative, or the alternative investment is to go and buy foreign currency, and that will put pressure on the Cedi, and it will worsen the case, of the foreign stability. So we need to work cautiously, because inflation, which is almost a determinant, is being tamed by the policy rate. And as I speak to you, we have inflation of 23.1, and the policy rate is 27. I'm wondering how people want to even buy an investment which is lower than inflation rate. I'm wondering, any rational human being, like I sit here, I will never, ever buy treasury bill when the inflation is bigger than my return.
But that is the economy we find ourselves in, Prof. So what options are quite available for investors?
After the DDEP, there are no options. The options are quite small. You look at alternative investment. What alternative investment we have? with such a high return. It's only government paper. And the government paper itself, the Treasury bill, were far more exceedingly above the bond. So we could see that we were heading for disaster. You couldn't pay 19.1. You brought it to 9.1. And then you go to the Treasury bill and borrow 28%. That was good.
Yeah, Doc, I mean, in fact, let's look at, you made mention of 3 rates that I think that we need to put into proper perspective. The first one is looking at the 91-day T-bill rate, which is currently around 17.72%, I think so. You have inflation about 20% and monetary policy rate also about 20%. Definitely, looking at these 3 figures, huge differences. And for me, that shows the kind of gaps that we have, that we are currently not having that equilibrium. Because the truth is that in any well-functioning economy, so long as you have T-bill rates coming down or trending downwards, monetary policy rates should also come down. Inflation should also be around the same level. But it looks as if the kind of structural problems and monetary policy problems we have is the reason why we have some of these gaps currently.
Well, you're damn right. We have had these structural imbalances over a long time, especially when we came after the DDEP. It's becoming worse and worse because you can't have a treasury rate 38%, and you can't have a policy rate also 20-something%. What it means is that you are not synchronizing very well. I think we are not synchronizing very well. The linkage between the inflation, the treasury bill rate, and even the lending rate and the policy rate. So it makes it very difficult for people to do planning. And unfortunately, you said investors' confidence. Because they had no alternative. Because they have no very viable alternative. That is why they buy treasury bills. Other than that, for me, if in my shoe, if I had that amount of money, there's no way I'll buy a treasury bill. I will hedge. I will hedge in FX.
So, Doc, at this point, would you say that there is some sort of, gap between the decision of the central bank and that of the finance ministry? Because, I mean, these two institutions must be moving in the same direction. They should be on the same tangent. But it looks as if, I mean, what is currently happening where the finance minister happily mentions, announces reduction in treasury bill rate. But this looks like if you analyze it in the long term, this can pose a lot of, restrictions and a lot of problems for the stability of the city. And I was just telling Winston that the reason why possibly we are seeing a stable city at the moment is the kind of situation we have around the current geopolitics, where people are no longer seeing the dollar as a store of value because of maybe what is going on in the US, the man called Donald Trump and all of that. But once you take away this factor, it looks as if when the dust settles and investors begin to relook at their decisions, connect the dots. Yeah. They possibly will be looking at, investing in maybe the dollars, right? And that shows the kind of difference we have between decision of the central bank and maybe the finance ministry.
And I also think that it's going to be interesting considering the economic fundamentals that were before this first quarter of 2023. We saw quite inflation going down marginally. However, it keeps going up and down.
It actually went down significantly, right? Yeah.
And right now, we are looking at the businesses complained before the election, and the government has put in place some policies saying they will deliver this and that. But we look at how it will impact domestic businesses. The indication of the upticks that the government is giving as a result of rejection of over 30 billion Ghana cedis on the treasury bill market possibly gives a signal that government is trying to manage its fiscal it's trying to be fiscally prudent in that direction, ensuring that its fiscal consolidation program is well adhered to. And if you look at it from an external point of view, for instance, international investors, they may say government seems to be handling its debt outlook positively, because at the point, government did not have an option in terms of deciding how much they have to take and how much they have to reject. And they were taking
Winston, this also paints a different picture, and I want to bring Doc in. Right, government wants to be disciplined, but you have $13 billion Ghana cedis. There's free money available, and people want to invest. And it looks like currently, I don't see the kind of synergy maybe between the finance ministry and the Bank of Ghana. Doc, what do you have to say about this? Because I know that, I mean, these two institutions must work hand in hand. But this looks like, that's not what is happening at the moment.
Thank you very much. It takes two to tango. I talk the monetary side and the fiscal side. Any investment or investor coming in will look for a stable currency, right? It will look at a stable currency, look at lower inflation, and then possibly look at your fiscal deficit. How low is your fiscal deficit? That is the reason why these three should synchronize very well. Because if you have a local fiscal deficit and you have a bad currency and you have a higher inflation, the investors are not going to come in. Any sound economics or environment will tell you that you need a sound microeconomic environment, make up of lower inflation, stable currency, and a lower fiscal deficit. We can talk about investment going, but the real investors will look at these three key variables which influences investment. All those who are buying the treasury could even be speculative people. They are not real investors. They speculate and take opportunity of the entire interest rate and then get away. But any good investor would have to think about the stable currency, lower inflation.
I mean, once T-bill rate begins to go down, especially the 91 days, we possibly should see banks shifting from lending to government to the private sector. But it looks like that's not the case. Everybody wants to lend to the government. Does that mean that the banks currently, even the banks, because you see the participation rate of the banks in the purchase of T-bills, does that mean that the banks do not really have confidence in the private sector, as a result of the current non-performing, loan rate that we currently have? So high, more than 20%, that is actually posing a problem to the banks by lending to the private sector.
Thank you very much. When we talk about the non-performing sector, the governor even said it recently. It is only the domestic banks, including the SOEs. The foreign banks have only bought treasury bills. They bought treasury bills and made very good returns and going to declare profit. They don't go into the real sector of the economy. So they don't have high non-performing. You can go and check your books. I know one bank has low as 5%, whereas a bank has 81 and the other one has 72. These are state banks. And I'm saying that because people think that we can get away from taking a short-termist approach by buying treasury bill and making better return, declaring dividend, transferring the money out, that is what the banks, the 14 banks, basically are doing. They are not for the real sector. So even when there is crowding in, currently we could say there is a crowding in. Crowding in, instead of crowding out, instead of treasury bill rates going up, it's going down. So we would have thought that private sector would enjoy the lending rate will drop down. The private sector would have businesses to expand. But unfortunately, we haven't reached that level because the 14 banks here in Ghana are not just looking at the growth, the real growth of the economy. They think there are opportunity for them to exploit the system and declare dividend. And we have to be very, very, very cautious. Anytime we are talking about that, any country that has more foreign participation stands at times of losing basically everything. The reason why I'm saying this, come April ending and May, you will see the amount of dividend that will be transferred out of this country. And that will put excessive pressure on Bank of Ghana, the Bank of Ghana to give the foreign exchange.
Prof,
so
the last time you made the suggestion, the last time the central bank and the finance ministry were in bed together, it didn't turn out to look too good for the economy. There are times we were complaining about the numbers, whether some of them are the real reflection of the economy. You were proposing for that. We saw what happened previously. This time round, what cautious measures do you believe should rather be taken going forward?
The central bank's operational independence under the Constitution must be religiously and strictly observed. Number one, we used to have the fiscal responsibility. Bank of Ghana, you can't do far more 5%. They chose to do far more exceedingly above the limit. So the Bank of Ghana should play its role so that it does not become a victim of what we have seen. That is why I have been agitating that it is not only upgrading the fiscal responsibility Act 982 into something else. Let us have a constitutional limit like the Americans, like the Namibia, like Kenya, like Poland. They say that you can't do more than 50% debt. Because if we don't have this, and all these things that we are talking about are not going to solve the problem. People will manipulate the figures and they go to the parliament because they have the majority and get vote out of it. But if it's a constitutional thing like the Congress Act, nobody can beat the 50% GDP ratio. Unfortunately, the central bank was not operationally independent. So you have the Ministry of Finance influencing them by monetization of fiscal deficit. And that has resulted in the situation we have today.
Yeah,
I keep on saying this.
Yeah.
Before I go, I keep on saying this. Inflation, even the 11.9% inflation targeting of the year, I'm beginning to doubt it. Because what are we doing to halve it?
But Doc, I believe that by the end of maybe next year or this year, we should be able to hit that 8% plus or minus 2.
Oh, it is going to take us more than that. We have to do far more. Because you see, your food inflation, Kwame, Kofi, you have been in, you and your brother, you have been in for long. You've been talking about food inflation, and it has never changed. And it's not going to change today. It takes a medium to long-term project before you can change it. Unfortunately, we are not doing anything. We are not doing anything about it. And once the food inflation is up, you're not going to get inflation down.
Well,
we should get it clear.
I mean, Doc, Winston and I were actually discussing that. I mean, you are looking at this from a different angle, but we saw that there are two things that the government wants to do: finance majority of its fiscal deficit this year in the domestic space, like they did in 2024. But there's one thing they want to do is to start the reintroduction of local, issuance of local bonds, right? So maybe we're looking at it this way, that if you have T-bills still around 28%, 27% or 20%, then that means that if government is coming back into the bond market, it will be forced to, give rate or coupon rates around 30% or 32% to make it attractive. But once you begin to drop T-bills from the high levels of 28 to 17%.
It will be difficult.
Yeah, exactly. So when you have the government coming in to issue bonds, they can now start issuing the bonds around 22%, 23% or 24%, because that will be relatively higher than the T-bill of 17% or 18%. And you have more people now, moving from the T-bill market into the long-term market, or the market that has most of the long-term securities. Doc, could this be the strategy of the government, that reduce T-bill rates so that you make the new bonds that you want to issue attractive?
Kofi, let me be very blunt. Whoever tells you that after defaulting 2 years, you go to the market, it doesn't work anywhere. The minimum you need, according to literature and IMF, the minimum you need is about 3 to 5 years, not 2 years. Because your credibility is still in tatters. Because if you issue the bond, how are you going to pay them? Because you have a debt overhang. A debt overhang. How are you going to pay? So I have said that. Why don't we take our time, look at it for a period 2-3 years, and see how the economy will go. The economy is not in a better shape.
So you don't think that the government should come back to the bond market now?
Not at all. Not at all. There's a literature, empirical literature, that says that you need 3 to 4 years, especially when you are defaulted. So it's not just because people are buying treasury bill. They are buying treasury bill because it is short-termist investment, and you can exit within 90 days or 180, or immediately you move it to 1 year. People are going to say, what is this? Are they not junk? You need to create an enabling environment where the economy, the inflation is down, Cedi is stable, and your fiscal deficit. Look at what they said. They said that the target of primary surplus of, I think, 0.6 is now a negative of 3 point something.
Yeah.
I mean, and if you look at the budget, if you see the funding, the cost of the difference between primary concessionally, and then if you go there, what are we financing it for? We're using some monies from somewhere to balance it. So we should be cutting our coat according to our cloth and begin to realize that we need to get our acts right.
All right, Doc.
We are talking about this. Corruption has taken a chunk of the country, and nobody talks about it. So we can't rush. If they rush, I'm saying I'm not the prophet of a Jew.
Okay.
It will be one of the massive failure in bonds, not even Ghanaians. Because if you hear how many foreigners who bought the bonds, Ghanaians outside.
That's about $1.9 billion.
That's right, mate.
1.9 billion dollars.
Converted by 15, close to about 20 billion.
Yeah, that's huge. I mean, even the commercial banks were also in the mix. You heard Doc, he says that
if you rush, you crash.
Yeah. Yeah, it is not the right time for the government to go. I mean, but that's in the IMF, review that government is supposed to start, the reintroduction of bonds issuance in the second quarter, which is just about some few days away.
The government has to be cautious to balance the ties. Currently, if you look at the 2025 budget, about 83.3% of it goes into compensation, interest payments, and all the key structural adjusted in the budget. And that is a key challenge. Less is going to CAPEX, that you see the capital expenditures and all. And government promised a lot of infrastructure development, continuation of previous government's projects. Where would the funding come from? The government has to be cautious. So cautious optimism is what we are working with. We've seen growth being indicated with the mining and quarrying being the key sectors boosting the economy. We want to see if to look at
a 360 growth, right?
Exactly, 360 growth. And balancing the ties. First quarter, we are watching. How would the rollout of the various government policies be? With the lack of access to financing is going to be a key challenge for government. We are hoping that its plan to ensure digitalization in terms of collecting of toll, which is less than the previous betting tax estimate, compared to key options that government has in raising revenue. We are just going to observe to see how it's going to prudently do that. Because if you look at the projection of revenue, ISE, Institute of Economic, said that the projections are overly ambitious.
Now, Winston, that's a nice way to end the show, right? But, I mean, the real biggest headache is how, this falling T-bills that we have, how difficult is it going to make, the Bank of Ghana, the Monetary Policy Committee? They will be meeting. We are expecting Mahama's first monetary policy, the governor's first, MPC report and where they'll peg the rate. But looking at some of these numbers, you have T-bill rates, 91 days around 17%, inflation is still around 20%. I mean, it makes it difficult for the bank to take a decision now. I mean, we'll be doing this extensively on Friday, trying to see which direction should the Bank of Ghana go.
I want to get your projection. T-bill projection.
Well, I mean, we would have to do some, dotting.
So they should expect it on Friday.
Exactly, on Friday they should actually, expect it.
I have a number in my head right now. Look at that.
You have your number in your head?
I have a number in my head. So
I've written mine in my palm anyway.
Expect it on Friday. We're going to give you analysis of. By Monday, we should know what will be the current monetary policy rate by the central bank. What has been taken into consideration before the final outlook. The central bank governor, this will be his first MPC.
I know, Dr. Chan will actually join us on Friday to actually break this down. We are looking at the direction that the bank should go. And as a result of some of this background story that we have given you, how difficult would it be for the Bank of Ghana to decide on the new governor's first monetary policy rate? This has been Beyond the Numbers with me, Isaac Akufo-Addo. I always do this with
Winston Taki. See you same time, 5:30 p.m. on Friday. Make sure you keep it locked. Have a wonderful business day. Bye-bye.